The term offshore bank account carries a heavy load of Hollywood mystique and often unfortunate stigma. It conjures images of secret numbered accounts, espionage, and illicit fortunes. But in the real, regulated world of global finance, the vast majority of offshore banking is a mundane, legitimate, and highly regulated service used by expatriates, international business owners, investors seeking currency diversification, and individuals planning for global retirement. The core question isn't whether it's legal, it absolutely can be, but how you do it legally, safely, and wisely. The dangers aren't spies and assassins, they're choosing the wrong jurisdiction, misunderstanding tax reporting laws, or falling for a scam posing as a private bank. Today, we're cutting through the fiction to provide a concrete, step-by-step guide on how to open an offshore bank account the right way. This is about navigating a process built on transparency, compliance, and due diligence. We'll cover how to define your legitimate purpose, select a stable jurisdiction with strong regulation, choose a reputable bank, navigate the intensive documentation process, and remain in full compliance with the laws of both your home country and the bank's country. This is a roadmap for accessing global financial services, not a guide to evasion. The entire process begins with a critical, introspective step, defining your legitimate purpose. No reputable offshore bank will open an account for privacy or keeping money safe from taxes. You must have a clear, justifiable reason. Regulators and compliance officers scrutinize this. Common legitimate purposes include 1. Geographic diversification, holding assets in a stable foreign jurisdiction or currency to mitigate country-specific economic or political risk. 2. International business operations. You own a company that invoices in euros or has suppliers in Asia. A local account streamlines operations and reduces FX fees. 3. Expatriate living. You live, work, or are retiring abroad and need a local account for daily finances and receiving pensions. 4. Estate and succession planning. Structuring assets for an international family across multiple countries. 5. Access to specific investment opportunities. Some investments, like certain funds or deals, may only be accessible through institutions in specific financial centers. Having a clear, documentable purpose guides every subsequent choice and is the foundation of your application. With a purpose defined, you now face the most important decision: choosing the jurisdiction and bank. This is not about finding the most secret place, but the most appropriate one. Key factors include political and economic stability. Look for jurisdictions with strong rule of law, stable governments, and healthy financial sectors, e.g., Switzerland, Singapore, Cayman Islands, Luxembourg, Channel Islands. Regulatory quality. Ironically, you want a jurisdiction with a strong, transparent regulatory body that enforces international anti-money laundering (AML) standards. Weak regulator is a red flag for scam banks and future instability. Reputation. Some jurisdictions have worked hard to shed old stereotypes and are now leaders in compliant, professional finance. Practicality. Consider time zone, language, ease of travel if required, and the jurisdiction's network of tax treaties. Once you've chosen a jurisdiction, research specific banks. Prioritize large, established, internationally recognized institutions or well-regulated local banks that specialize in serving your profile, e.g., expat banks, private wealth managers for high-net-worth individuals. Avoid banks that promise anonymity or that you can only find through a flashy website with no physical presence or regulatory license. Now, prepare for the heart of the process, the application and KYC AML documentation. Forget the myth of walking in with a suitcase of cash. Opening an account remotely or in person is a paper-intensive exercise in proving you are who you say you are. Your money comes from legitimate sources, and you are low risk. The Know Your Customer kick and anti-money laundering AML requirements are exhaustive. You will typically need 1 certified passport copy, often notarized or apostilled. 2 proof of residence, utility bills or bank statements from your home country, usually not older than 3 to 6 months. 3 professional reference letter from a lawyer, accountant, or a bank you've had a long relationship with. For bank reference letter from your current bank. 5. Proof of source of wealth, funds. This is critical. You must provide documents showing where your money comes from: several years of tax returns, business financials, sale contracts for property, investment statements, or inheritance documents. 6. Detailed CV resume, explaining your career and income history. 7. Account purpose letter, a formal letter explaining why you want the account, tied to your legitimate purpose. All documents must be in English or officially translated. The pro tip is to contact the bank before gathering documents to get their exact, current checklist, as requirements can vary and change. Assuming your application is approved, your work is not done. You enter the phase of ongoing compliance and tax reporting. This is where many people unknowingly break the law. 1. Home country reporting. For U.S. persons, this means filing an FBAR FinCEN Form 114 annually if your aggregate foreign account balances exceed $10,000 at any point in the year. You may also need to file IRS Form 8938 with your tax return. Other countries have similar regimes. Under the Common Reporting Standard CRS, where over 100 countries automatically exchange financial account information, your offshore bank will report your account details to its local tax authority, which will share it with your home country's authority. To maintaining the account, you must keep your contact information updated with the bank. Expect periodic requests to reconfirm your KYC information. Use the account for its stated purpose. Sudden, large, and usual transactions will trigger compliance reviews. 3. Tax obligations. Having an offshore account does not make income earned in it tax-free. Interest, dividends, and capital gains are typically taxable in your country of residence. You are responsible for declaring this income. The legal strategy is about structuring, not hiding. Finally, let's address the risks and how to mitigate them. The primary risks are not legal if you're compliant, they are practical. 1. Complexity and cost. Offshore banking often involves higher minimum balances, account fees, and legal advisor costs. It's not for small amounts. To scams and unstable banks, mitigate this by only using banks listed with the jurisdiction as official financial regulator. Through regulatory change, laws evolve. Jurisdictions can be blacklisted. You must stay informed, often with professional help. For access and liquidity in a crisis, being able to access funds or communicate with your bank is paramount. Choose a jurisdiction with robust digital banking infrastructure and consider maintaining relationships with multiple financial institutions. In conclusion, opening an offshore bank account safely is a deliberate, transparent, and compliance-heavy process for achieving specific, legitimate financial goals. It is the opposite of secrecy. Your roadmap is clear. Define your purpose, select a reputable jurisdiction and bank. Meticulously prepare your KYC AML documentation, and rigorously fulfill all ongoing tax and reporting obligations to both the foreign bank and your home country.